Hello and welcome to Chapter 9. We're going to talk about bonds. Bonds is like any other contractual IOU, meaning that it's pretty much like a loan, but it's a privately issued loan. And let's say a corporation needs money to build a new factory, and instead of borrowing from a bank or instead of selling stocks, it decides to issue debt. And like any other debt instrument, it has a maturity. How long is going to be that loan? And it promises, in this specific case of the bonds, to pay a fixed amount per bond, and in the meantime, it pays an interest for that loan, what is called a coupon rate. And let's say it's 10% paid semi-annually, where semi-annually means every semester. Now this is what the issuer of the bond is offering to whoever buys the bond, and then we need to compare what the issuer of the bond is offering to the prevailing market interest rate for similar assets. Meaning what? We could buy the bond, or we could put our money in, for example, a savings account earning 8% per year. Now, given these conditions, how do we find the fair price for the bond? How much should we pay for this bond that offers $1,000 in 3 years from the moment you buy it, and in the meantime is giving you 10% interest on what? On the face value of the bond. So basically 10% of 1,000 is $100. So the issuer of the bond is basically saying, if you lend me money now, I promise you to give you back $1,000 3 years from today. In the meantime, I'm going to pay you 10% per year on that loan, meaning I'm going to give you $100 per year, but paid in 2 installments per year. Or in other words, $50 per semester. Given that the prevailing cost of money is 8%, how much are you willing to pay for this bond, basically to lend to the issuer of the bond, in order to guarantee that you get at least 8% return? So the key concept here first is to draw, as usual for any financial security, the timeline. So note that the coupon rate is in semesters, the interest rate is given us per year, but it compounds semi-annually. So everything has to be envisioned in semesters. This is a case 1 from chapter 2. And we're going to have 3 years, which means 6 semesters. So we need to figure out the coupon payment. Coupon payment, it's equal to the coupon rate times the face value, where the face value is basically this future value that the bond pays. Curiously is also FV, right? So this is the face value of the bond, which you can interpret within the realm of time value of money as the future value that is promised to be paid to you. So the coupon rate is going to be 10% per year, but it's paid in 2 installments per year, because every year, as you know, has 2 semesters, and the face value is $1,000. So this means $50 per semester. So if we buy the bond, we're basically buying the right to collect $50 every semester from the bond issuer, and at the end, on the top of this $50, by the end of the 6th semester, we also gonna be getting $1,000. Note, there's nothing here that you're gonna collect at time 0. So this is an annuity of $50 over 6 semesters, and that is the face value to be paid upon maturity, upon 3 years, which means 3 semesters. Now, to find the fair price of this bond, means that we have to find the present value of these cash flows, discounted at the minimum acceptable rate of return that we want, or in this case it could be called the market interest rate. So we're going to compute the present value of this annuity today, and then add to it the present value of those $1,000. So the fair price, this is a terminology used in finance to refer to basically the net present value of a financial security. How much is that security worth in today's dollars, given the expected stream of cash flows? Now we're calling this a bond because it comprises an annuity plus a payment at the end. This is the typical setup for bonds, but you call this any other name you want. The important thing for us is to visualize the cash flow stream associated with a certain financial security, regardless of its name, and then compute the present value. So as of now, you are equipped pretty much with the tools necessary to compute the fair value, the fair price of anything, as long as you know the expected series of cash flows. So the net present value here is the $50 annuity, present value of an annuity, 1 minus 1 plus the interest rate, and note the interest rate is 4% per semester, right? We should probably look into that, just to remind you of chapter 2 as a mini review. I'll do that in a second, if it's not yet obvious. But so the present value of an annuity, the N is 6 semesters, the interest rate is expressed in semesters, the cash flow is in semesters, so all is okay. Then we have to have these $1,000 discounted at 4% during the same 6 semesters. What I was trying to say about the interest rate is that note that the frequency of compounding from chapter 2, what we used to call J, it's equal to the frequency of the cash flows, what we used to use the letter M for. So this is what we call a case 1, and therefore the interest rate is basically equal to the nominal divided by the number of cash flows. So that'll be the 8% per year divided by the 2 semesters per year. So this means 4% per semester. So this is bringing back chapter 2 teachings, realizing what is the proper interest rate to use. Well, that depends on the frequency of compounding and the frequency of cash flows. The interest rate compounds semi-annually. The cash flows happen semi-annually. So that's clearly a case 1. That's where the 4% come from things we learned in chapter 2. So the present value, fair price of this bond would be so if we want to lock a 4% return per semester, the value that we would pay for this bond would be $1,052 plus 42 cents. If you pay this amount for the right to collect $50 per semester over the next 3 years, plus $1,000 at the end, you are locking a return of 4% per year. Note that you are paying more than the face value, and that's because the market interest rate is below the coupon rate. Note this: what if the market interest rate was 10% per year? So the market is offering as much as the bond issuer. The interest rate per semester would be 5%, and the fair price for this bond would be equal to its face value, because the return on the bond, it's equal to the return on the market, or if you want to think about your minimum acceptable rate of return. What if the market is offering higher return than the bond, let's say 14%. Well, the interest rate per semester then would be 7%, and consequently you would pay less than the face value. How much? You would pay for this bond $904 plus 67 cents. So what we have seen here was the rules of thumb for pricing bonds that are bought on issuance and held until maturity. That's when these rules of thumb apply. When you buy the bond when it's issued, first issued, you're not buying from Joe or Joanne, you're buying directly from the issuer of the bond, and you hold the bond until maturity. If that is the case, then if the market interest rate is equal to the coupon rate, then the fair price is equal to the face value. If the coupon rate is greater than the market interest rate, then the fair price is greater than the face value. If the bond is offering less than the market interest rate, then the fair price is below the face value. These are the rules of thumb related with bond purchasing. But these only apply if you buy the bond when it's first issued. Now, a different type of example that usually students struggle with. Let's say we're going to buy the bond after 4 coupon payments. Okay, so this was the original cash flow series when the bond was first issued. And now, let's say you're going to buy the bonds immediately after 4 coupon payments. So that means you're going to buy it here, immediately after the 4th coupon payment. So the text would read that you are buying the bond right after the 4th coupon payment. What does that mean? Well, it means that you missed these coupons. Those are not for you. And this moment in time is going to become your time zero. And your time zero, because you're buying it right after the 4th coupon payment, there's nothing for you. But if you buy it there, you're buying the right to collect these 2 remaining payments plus the $1,000. Right, so there's 2 semesters left. In one semester you're going to collect $50. In another one you're going to collect $50 plus $1,000. So how much is this bond worth for you at this moment in time? Well, you would compute again the net present value, the fair price. That will be 50. But let's keep on using this 14% interest rate per year, compounded semi-annually. And given that the payments are semi-annual, that means 7% per semester. So that will be 7% per semester. There's only 2 semesters left. 2 $50 annuities. And then you collect the $1,000. Discounted for 2 years. How much should you pay for this bond? And the answer would be 963.8 for the sake of space. 0.84 if you want to be more precise. So this will be the fair price of this bond if you were to buy it in a secondary market, meaning in an exchange. Let's say you're buying the bond from John that initially bought the bond when it was first issued but then needed the money, so he cashed out by selling it to you. And the fair price that you should pay in order to lock a 7% return on this investment is $963 plus 84 cents. So the timing of the purchase is right after the fourth coupon payment in this case. If it is right after the payment of a coupon, means that at your time zero there's nothing for you. What if I was to say that you're going to buy it right before the fourth coupon payment? If you were buying it right before the fourth coupon payment, meaning you're buying it here just before that payment is made, it means that at time zero, if you bought it right before the payment is made, then that cash flow is for you, and that will be your timeline. Well, in that case, how much would you pay for this bond? Well, it's like the beginning of the time period payments, right? All that you need to do in this case, since we have the formula already here, is to add $50 to it, because the present value of $50 today is $50, right? So you would pay basically $963.84 plus $50. So $1,063 plus 84 cents. $50 more than if you were to buy it right after that coupon payment. So the timing of the bond purchase is very important to pay attention, because that determines the proper timeline. If the question says you're buying it right before a coupon payment, it means that you're going to get a cash flow at time zero. If the question says that you're buying it right after a coupon payment, it means that you get nothing at time zero. Right? The difference between the two scenarios is, if you are buying it right after a coupon, the typical annuity formula applies. If you are buying it right before, you just need to add this cash flow at time zero to the computations. So that's it about the timing of the bonds. Okay. Now let's talk about taxes. These are considered interest payments, and you need to pay taxes. Now let's go back to the initial scenario, because I need space. So this was the initial scenario, but now let's say you have taxes and your tax rate is 20%. Well, if we have to bring taxes to the equation, then we need to talk about the net coupon payment. And the net coupon payment is going to be equal to the coupon payment we computed before, that is the coupon rate times the face value, but now 1 minus the tax rate. Remember that this is the 10% paid semi-annually, right? So this was the 10% divided by 2 times 1,000. That was the $50, right? And now, given that the tax rate is 20%, you are only going to keep $40. So once you figure out how much are you actually keeping, giving your tax rate, then we need to update the coupon payments to reflect taxes paid to Uncle Sam. So given that you're going to pay taxes, what should be the fair price? This is not taxable. This is the face value, that's the principal. What's taxable is these interest payments paid to you, which are called the coupon payments. So the net present value of fair price in this case then will be the 40, 1 minus 1 point, still using the 7% per semester. This is 6 semesters, plus the 1,000, 1.07 power of 6, and this would give you, now for the fair price for you would be only 157.00 actually. So if you have taxes in the equation, you need to pay those out of the coupon payment. And once we have the net coupon payment, then you proceed with the same computations. Now let's say that on the top of taxes you also have a broker, and the broker charges 3%. So If the broker is to charge 3% fee, it means that this is not how much you are willing to pay anymore. You need to pay the 3% out of this to the broker. If you need to pay the broker's fee of 3%, then the fair price you are willing to pay, it's equal basically to the net present value divided by 1 plus the broker's fee. So meaning 857 divided by 1.03, $832.04. So these are all the kind of nuances you may face when dealing with bonds. But above all, the most important one is the timing of the purchase and making that timeline. The taxes and the broker's fees are little challenges compared to the timing. So in sum, if you have taxes, you need to deduct it from the coupons. That is, find the net coupon payment. And if you have a broker's fee, after you do the computations, you need to take out the money from the net present value to pay the broker. Right? So divide the net present value by 1 plus the broker's fee, and that's how much you are willing to pay for the bond, given that you're going to pay 3% to the broker and 20% to Uncle Sam. That's it for bonds.